All right. Good morning, GPAR. Matt Braden here from the professional staff. So happy to see so many folks with us. We have a great speaker today with Lawrence Yun. But before we get to that, go Phils. Big game this afternoon. We're waiting for word from the Atlanta Association. We challenged them to a friendly bet, just like we did with St. Louis, which we won some eats, sweets, and treats. Waiting to hear back from Atlanta. So hopefully they take us up on our offer. Thursday, we're going to have another one of our workshops. We hope you will join us at 1 o'clock in the afternoon. Painless ways to generate leads with Janice Benstock. So you know Janice, she does an awesome job with her presentations, and we hope that you'll join us for that. And if not, we'll always have it in the YouTube video archive. So with that, good morning, Dr. Lawrence Yun. How are you?
Thank you for inviting. Hello, everyone.
The floor is yours. We're ready for your most recent report and update.
Okay, great. So thank you for inviting, and again, President Jake Markovitz for arranging this, because market is changing, and you know you are feeling it right now. The mortgage rate having shot up this high, this fast, is quite unprecedented until one goes all the way back to the early 1980s when they were raising interest rates such that mortgage rate eventually hit 18%. Now, calm down. We will not hit 18% mortgage rates. I hope we are topping off at 7% mortgage rates, but we will still feel the pain of the 7% mortgage rate for a while until the economy truly improves. So we are in a transition. After two spectacular years, 2020, 2021, quite a growth, but now quite a challenge, especially for those large brokerages who have this, office spaces which they have to pay rent, and then how do you adjust or back office staff? So it is quite a tough time for the industry with this sudden spike in mortgage rates. I speak better with the PowerPoint, so let me put that onto the screen. And congratulations on the Phillies. I remember when I visited the national game several times in Washington, when Philadelphia visits, I see a huge section of Philly fans out in they bring large contingent. And that's when Bryce Harper, by the way, was national to see home run. But congratulations on Philly's success. So let me put that onto the screen. All right, so let's first start with this mortgage rates. So this is a long-term chart on mortgage rates from 1990 until most recent. So general trend until recently has been fairly downward slope. And the reasoning for that was inflation was well contained, no worry about inflation. So the lenders were willing to lend it at a lower interest rate, knowing that the money they lend still has value. But in a high inflationary environment, it just means that lenders are more cautious. They know that money that is returned would have lost value, and they don't want to lose money like that, so they have to charge premium. Now, the Federal Reserve raising interest rate also contributing to the process. But one interesting part about this graph is the following: resistance point. Because Wall Street terminology, they look at what are some economic news that drives the stock market. And I know we are feeling the pain of our retirement fund evaporating because stock market is tanking. But there are some analysts in Wall Street who do something called technical analysis. Independent of economic news, they look at some chart analysis. And I put that 3 red bars to indicate something called resistance point. And the way to view it is whether it is stock prices, bond prices, interest rate, once it hits resistance, it battles it out. You're trying to see whether it's going to cross. And if it doesn't cross, it retreats back down. But once that line is punctured, then it begins to make a huge gain. It's almost like an army battle, 2 armies battling against each other. But once the line collapses, the winning army makes a huge advance until they hit the next resistance point. So what this chart shows is that the first resistance point, the low point, it just bursted through. And therefore, it quickly went all the way up to the second resistance point, which we are currently. If we can hold at this level, that means that mortgage rates will top out at 7% and possibly even retreat back down to say 6.5% or even 6%. But if it punctures this second resistance, then one is looking at possibly 8.5% mortgage rates. So watch carefully on what's happening on and whether it gets punctured. Now, first thing I do every morning is I check the bond market as to what the mortgage rate trend would be. The blue line is the interest rate that the US government pays to borrow money. We know the US government is running a deficit. Nothing is free lunch. So you put money here, money there, and money everywhere. It is deficit financing. Government has to borrow money. So what is the interest rate government pays? It is the blue line. The red line is the same mortgage rate, but one can almost see it moves in lockstep. So first thing I do every morning is I try to look at 10-year Treasury yield. Is it moving sideways? Is it going to puncture that resistance point or whatnot? And right now, the 10-year Treasury appears to be, again, battling at their resistance point and trying to see whether it's going to retreat back down or go up higher. I think the consumer price inflation data that will come out this week will be a big event as to whether it retreats back down, test it out at the resistance point, or puncture the resistance point. But that's where we are regarding borrowing rates for the US government, borrowing rates by your clients, 30-year fixed rate mortgage. In the meantime, we know that the pending contract is sinking. So after 2 years of solidly above the red line, solidly above pre-pandemic levels, beginning of this year, we have seen steady decline in pending contracts. And it's actually below 2019 levels, below the full year before the pandemic. So again, it's painful out there. And we have seen a growth in realtor population, which means more realtors, but less business opportunity out there in the current situation. So very challenging, highly competitive, fiercely competitive situation in the marketplace. Here's the latest information that I got from Bright MLS. So covering the Pennsylvania region, which clearly covers the Philadelphia and generally southern portion of the Pennsylvania, shows that closing activity in the latest week is down 17%, 17.8%. Contract signing is down even more, 26%, because contract leads the overall, reacts more quickly to changes in mortgage rates. New listings are down. People would think, well, now that it is no longer seller's market, maybe the homes will stay on the market for longer, but the new listings are not popping because people are locked in at 3% and 4% mortgage rate, and they don't want to give that up. So trying to get new inventory could be very tough. And the number of showings, the very last line, down 30%. I guess they're just looking at the lockbox of movements, how much showing related. So overall trend is a downward condition. But as mentioned, inventory levels still remain fairly tight, even as people are not buying. So people are not buying, so one would see inventory rising, but it is a lift from a very low, tight levels. In fact, we have fewer inventory today compared to year 2000. Now, this is a national data. You can look through the Bright MLS to get a little more detail on your market, or say you can do your own analysis of your neighborhood. But one big difference, this is not 2008, when home prices began to crash, and then we had the foreclosure mess. Look at the inventory situation back in 2008-9 period, 4 times more inventory. So we are nowhere near that. Don't expect any major price decline. Some price decline, say 5% price decline, is that a possibility? And answer is yes. But 5% price increase is equally possible, given that we have low inventory condition. So the price collapse of 30%, definitely not in the card, because we don't have oversupply of inventory. And very good thing, we don't have those funny, risky mortgages that blow up. Subprime lending caused the financial crisis back in 2008. Today, we don't have those funny, risky mortgages. so we don't have to worry about blowing up of mortgages. In fact, the number of homes that are classified as foreclosure or needing a short sale at historic low. So distressed property sales are virtually non-existent. Your clients of the past few years, they are enjoying the low interest rates. They are happy with the price gains. You may want to remind them, how are you doing? Just to put the face with the home transaction, because they are very happy. Your past clients are very happy, no foreclosures, no short sales. It's only about the new clients. You are not getting that new clients, but your past clients are all happy. Now, home prices have risen, which is the reason why your clients are happy. I remember one survey 2 years ago saying, do you have any regrets that you bought a home? And I think some people said, yes, maybe I did not do home inspection. But the same person, if you were to survey again, I would assume, I would almost expect that they are so happy. And the reasoning is prices rose. And when prices rise, this is their wealth. The wealth they can use to pay for their kids' college education, the wealth for their retirement, just everything. So prices have been rising. The green is the Philadelphia. I should have put red for the Phillies, but I put green for the Eagles. But the green is Philadelphia. The blue is the US. So Philadelphia home prices pretty much follows the US trend until more recent years where it was slightly below. In fact, when I take the Amtrak from Washington all the way to New York and sometimes to Boston, I see that, Washington is expensive, New York is expensive, Boston is expensive, but Philadelphia is reasonably affordable. So that is one attraction that I think you can offer about to new people to say that, Philadelphia region offers the affordability. And of course, there's some beautiful homes, $2 billion homes near Bryn Mawr and everywhere. So we know that. But on average, Philadelphia is much more affordable city along the Northeast corridor. Now, this is what the realtors are doing across the country. The actual data from MLSs. Half of the home, or 51% of the homes, are still being sold at or above list price. So realtors are doing very good job in pricing the home right from the get-go. But other half, 49%, requires some price reduction. And it depends on the days on the market. So let's look at the very last column. 4.6%, 5.2%, 6.0% down the line, very last column. So these are price shavings for those homes that were sold. Days on the market reflect the time that it is listed and ratified contract. So home that was sold with a contract signing within a week, price negotiation 4.6%. But if the home is on the market for a month, price negotiation is 6.8%. If the home is on the market for 120 days, price negotiation is 14.9%. Something we sort of know, lengthier days on the market, larger price reduction, but maybe you did not know the actual number, or maybe you did not know what the realtors were doing. So this is what the other realtors are doing out in the country. Now, other column reflects price shavings of those homes that are still listed, not yet sold, and others are pending. We know that pending does not mean uncork the champagne and celebrate, because something could go wrong. Home inspectors are coming in and say there is 1,001 things wrong with it. So there's further price negotiation. So the point is, there is price negotiation, but the deeper the price negotiation are the one with closings. I mean, one that's not even getting contract, very little price negotiation, and maybe that's why they're not getting contracts. The importance of getting the price correct on the get-go. Otherwise, if it stays on the market, expect some price declines. Now, turn to the economy. Are we in a recession? And the answer is, it is unknown, because there is a committee that will determine whether or not we are in a recession about 1 year from now. I think the 15-member committee. I don't like the fact that there is a committee. I want an objective answer rather than subjectivity of 15 people. The objective answer is to say 2 straight quarters of a decline is a recession. So in a sense, We encounter a bump in the first quarter and second quarter. So objectively, one can say we are in a recession. The early part of the graph is the COVID lockdown. Nothing was happening, big red, and then bursting of the economy once the economy reopened. Sorry, Pennsylvania, that you were a latecomer in reopening the economy, but once the economy opened, there was more commercial activity occurring. But early part of this year, you see 2 straight quarters of a decline, recession or not. But one funny aspect, and another sort of supporting factor for recession is that stock market is down. So our retirement fund has diminished. We are frustrated part. So this is also indicating that something is not right about the economy. But the bizarre aspect of the current recession is there is more job openings. Blue line, help wanted signs. Blue line is showing we have help wanted signs in many industries, particularly in the service industry like hotel, restaurants, the school bus drivers, truck drivers, you name it, a lot of job openings. But the red line or orange line is people who are searching for jobs. So technically, it's possible to find 2 jobs for each one employed, but we know that the matchup does not occur easily. Mortgage broker who got laid off recently because refinance has completely collapsed. So a mortgage broker who is laid off, they will not accept job at 7-Eleven. So we know that. So it's going to take some time to get the alignment, but it was a strange situation that we actually have more job opening than unemployed. Now, overall job market for the US has fully recovered and then some. When I say fully recover, during the lockdown, we lost 20 million jobs. But now we have created jobs with each passing month, such that more Americans today are working compared to ever in history, more Americans. The only part is it's minimally higher because every year we should be setting a record because we have rising population. But at least we have essentially fully recovered from all those job losses. And the job gain is also leading to wage growth. Blue line is the wage growth. Wages are rising about 5 or 6% for people receiving W-2 statements. I know people in the audience, you are commission-based, so your income fluctuates, and it's a very difficult condition right now. But for people receiving W-2 statement, their income is rising about 5% a year. Unfortunately, the orange line, consumer prices are rising even faster. So any gain in wages are being wiped away at the grocery store and at the gas station. So loss in standard of living, people receiving Social Security will get about 8% adjustment next year because consumer prices are rising 8%. So Social Security checks should be getting that cost of living adjustment of about 8%. But the wages are rising 5%. Historically, good number, but still below consumer price inflation. If we look at 50 market variation, interesting pattern develops. Pennsylvania, minus 1.0. So what does minus 1.0 reflect? That means in Pennsylvania, there's still 1% fewer jobs today compared to March 2020, right before COVID. I mentioned that the US, we are fully recovered. Pennsylvania is not fully recovered. You are still down 1.0%. New Jersey is fully recovered. They're plus 1.1, but New York State is down minus 2.2. Some states are actually doing very well. Florida, plus 5.0, right before hurricane. So Florida was doing very well. Texas at plus 4.9. So you see some variation. Some states clearly positive, other states negative. Pennsylvania slightly negative, laggard compared to many other states. Now, if we look at specifically at the Philadelphia region, total number of jobs, what one finds is that there was roughly 900,000 people with W-2 income salary. Then it went all the way up to 1 million. So this is from 20-year time span, year 2000, right before COVID. Then COVID hit, massive job losses. Now trying to come back, almost there, but not quite. So almost there, but not quite. Ugly data, consumer sentiment index, as measured by University of Michigan across the country. People are saying things are not good about the economy. Maybe their retirement fund has evaporated. Again, grocery store is a daily reminder that something is not right about the economy. Another ugly data. Here's a Fannie Mae survey. Is it a good time to buy a home? So people are saying, no, it's not a good time to buy a home. Very simple question. Only caveat to this data is what people say and what people do not necessarily match up. Because look at 2020 and 2021. Do we see a surge in number of people who say it's a good time to buy? No, they were same. Yet we know home sales increased because interest rates were low. So if the conditions are right, people will jump at the chance. Right now, people are saying it's not a good time. And the data shows that people are not buying. But if somehow the mortgage rate hits that resistance and then retreat backs down, we could see somehow a semi-burst of buying activity coming onto the market. But the inventory level, again, very, very tight condition. So that's going to be tough. Here's something that you may want to explain to some of your clients. First, someone enters the market at 7% mortgage rate. You said that's high interest rate, but we know in America the beautiful, we can always refinance when the interest rate goes down in the future. Other countries, they don't allow, but in America, that's permissible. So keep that in mind. You go into at 7%, but maybe you can refinance later. But let's for some reason say interest rate do not go down. I mentioned about 5% growth in wages for W-2 salary employees. Social Security check will rise 8%. But if the inflation rises, then people's paycheck will steadily rise. So assuming 5% growth, the middle column is what I put as a monthly income. So currently someone making $80,000 a year, their salary rises by 5%. So you see the middle column, while the monthly payment is fixed. So how much of their income is going towards mortgage? Is steadily declining over time. So one of the thing about inflation is that it does benefit people who are debtors, meaning that who will borrow money, because that borrow money diminishes over time when there is an inflation. Something that your client may not be aware of is a factual information and something that you may want to share. Let's say that inflation is contained and salary do not rise 5%. Say salary rises only 3% because inflation is contained. That means mortgage rate would be much lower, maybe 5%. Then you can refinance. So either way, person could win out, either refinancing into low rates, or if inflation remains high, at least their income is rising while mortgage payment is fairly fixed. So my forecast is that 2022 is a difficult year this year because of rising mortgage rates. By year end, year as a whole, it will be down about 15% on units. Now, recent activity is down 20%, 30%, but the first quarter was decent, so annual total will be down 15%. Home prices, I think, will still be up about 10% nationwide. Philadelphia may be a little light because your job market is slightly lighter compared to the rest of the country, but clearly positive. But next year, I think the unit sale will again be down about 7%, but the prices, I don't see any deep collapse. Minus 5% possibility, plus 5% possibility, it could go either way. But if you look at the very last column, dollar volume revenue, 2 great years in 2020, 2021, and this year down, next year down, but it's only down in the single-digit percentage. We are going through this transition. So in this environment, best to everyone, my alarm is going off. So I have 1 minute remaining before I go into next session at 9:30. But thank you very much for attending. And thank you very much, President Jake, for inviting me to participate.
Lawrence, thank you so much for giving us some time. Jake, you have a couple of comments?
Yeah, no, Lawrence, I appreciate your time and insight, and I know you're a busy guy, so it's good stuff. It's not all encouraging, but it's not nearly as bleak as I think some of us are feeling. So it was good to hear.
All right, Lawrence, have a great day. Everyone else have a great day. We'll be posting this video very shortly, and go Phillies. Take care.